This is the Retirement Bullpen with Richard Warner. The team at Warner Financial Solutions want to help you feel confident about your retirement, no matter where you stand. Get more at warnerfinancialsolutions.com. Now, the Retirement Bullpen.
You got to talk about your 401k, your IRA. Is it still going to be here in 10 years? What's going on? This is Jeff Miles with Richard Warner of Warner Financial Solutions, and this is the Retirement Bullpen. Richard, first of all, good morning. You probably saw the article. USA Today put this out. There's a couple of economists who are talking about the 401k, IRA. These are basically, they're tax benefits when you're putting money into these retirement accounts, right?
Correct.
And so when you look at those, and there's a couple of economists that are saying that this could be a way to help fix the Social Security problem, because the income that could be taxed for people who are putting that money aside in these pre-tax 401k IRA accounts could be used to help offset the deficit, I guess you'd say, with Social Security. What are your thoughts on that? And should people start planning for maybe different types of retirement accounts moving forward?
You know, it's funny this topic came up. I actually had a similar conversation with the client here recently, and their fear was the Roth IRAs, the traditional IRAs, the 401ks are just going to go away. Right. And they're going to lose all their benefits from it and things like that. And I don't think anything like that would ever happen. But there's definitely two sides to this story, or two sides to this opinion, if you will, Jeff. Yes, if we stopped contributing money to 401ks or traditional IRAs, that creates more taxable revenue today. And I think it cites some ridiculously high number of tax revenue. How accurate those numbers are.
It's like close to $200 billion a year, they're saying.
Anytime we start getting into tax revenue, though, like wonky numbers just come out of left field sometimes. I feel like anyways.
Yeah.
But that's a side note. I mean, there's probably some validity somewhere that they come up with those. Here's the reality, in my opinion. If we stopped contributing to those today and we started paying the tax on that money, people could still save and invest. They're just not getting the tax deduction.
Right.
Companies aren't getting the tax deduction. I do think that would hurt the incentive of companies and investors to invest, which could create a ripple effect in the stock market. Could.
Okay.
That would be one negative. The other negative to that is, yes, it costs tax revenue today, but what are those accounts growing to 10, 20, 30, 40 years down the road? And
that was my next question.
How much tax revenue can that generate at that point? And this isn't really our topic today, but some people might be better off considering not putting so much into pre-tax and putting it elsewhere just because of the potential tax consequences down the road and what tax rates might be.
You know, it's interesting that you bring that fact up, because the weird part about these pre-tax retirement accounts is that, yes, you are saving on the tax on the upfront. But if you were to extrapolate that out over the course of time that you're putting money into this 401k, it's a lot smaller amount than what that account ends up becoming over the course of, the interest and everything else that you're going to be gaining over all of those years. Are you not actually going to potentially pay more in taxes on that same money down the road as opposed to saving it pre-tax now?
That is a question I have with almost every person or couple that walks into our office is we or they or he or she, whatever the situation might be, they planned on being in a lower tax bracket in retirement.
Right.
They plan on we're making X amount of dollars today. We're going to be making X amount less when we retire, and we're going to be in a lower tax bracket. And so people just naturally assume that, if I'm in a lower tax bracket or if I'm making less income, adjusted for inflation is what they're looking at, that we're going to pay less taxes. Is that true, though? A lot of times when you project that out, even in current tax rates, it's not true. But what happens if current tax rates are dramatically higher? I mean, we have how much debt in this country today? We're going to have to do something as a nation to get rid of this debt, to get in control of spending. And quite frankly, the government can't go out and pick up a part-time job like you and I can when we're going bankrupt. And I'm not saying the government's going bankrupt, but so don't misunderstand me here, but their source of income is taking it from us.
Yes, exactly.
My opinion is tax rates are going to be much higher down the road. And a lot of people are stuffing this stuff away, and they're going to have this large account down the road that the IRS at some point is going to make them take money out of, which is going to create higher tax brackets than they would even project based on today's rates, not even if rates go up down the road, which I think they will.
Yeah. When people start looking at their 401k options with their employer, obviously, I think most people would look at it from the perspective of wanting to take advantage of any sort of company match that they may have. You know, they may have like a 50% match up to 6% of their salary, something along those lines. Do you think that it's a good idea to contribute more, considering these tax questions, more than what the employer match would be over time as that account grows? Because once again, I mean, yeah, you're saving on the tax on the upfront, but you are going to be paying taxes on this much larger amount down the road once you retire. Do people have a real clear idea of what that looks like when they come in to talk to you about their 401k?
No, they don't. They have ideas what it's going to project out to, what it's going to be worth. But what they don't realize is that big pile of money has never been taxed, and it's creating a potential mess down the road. So my encouragement for people is, yes, get that free money, because it's free money.
Yes.
I mean, no matter what the tax rate is on it down the road, it's still free money to you. Once you hit that maximization point in your 401k to getting every free penny you can out of your employer from their matching contributions, my next level would be to encourage them to contribute to the Roth side of their 401k, assuming they have that. A lot of them do, and they don't even know it anymore. I tell that to people all the time. I talk to people all the time. Do you have a Roth option? They've never heard of it, but then they look into it and find out, oh, wow, we do have a Roth option in our 401k. This does not reduce your taxes now, but it grows tax deferred and comes out tax-free later on down the road. So once you've hit that maximization of the free money, then I would consider looking at Roth. And if they don't have an option in there, look at doing it on the side if you can meet the income restrictions and qualify to be able to contribute a traditional Roth, because that's tax-free money they can utilize in retirement down the road that they don't have to worry about the IRS coming in and getting into their pockets.
You know, it's interesting that you mentioned that part of it, because I think that so many people, when they go and they start looking at their contributions, and you see this, you hear it all the time. You may read articles about it all the time about max out your 401k, max out your 401k, max out the ability to, you know, use pre-tax dollars to create a retirement plan for yourself down the road. Going back to that idea that you're talking about, where instead of paying something into a pre-tax account, but more into like a Roth, where yes, you are paying the taxes up front. If you look at that from just a simple math perspective, and let's just say that you contribute $10,000 to a Roth 401k in the course of a year that you are taxed on, and let's just say that that tax is 20%, or whatever it may be, that now grows over the course of time. And let's say that 20 years from now, you've got an account now that's got $200,000 in it, that you don't have to pay taxes on that. But the weird part about it, and Richard, this is why it's great talking to you about these specific different avenues. Does that, even with the Roth 401k or a Roth IRA, whatever it may be, does the amount that you have, and especially once you get to that point where you have to start withdrawing that money, that's also going to be a part of what is considered your taxable income when you retire. And all of these affect what that tax rate is going to be on, say, these pre-tax accounts that you have that have grown over time. You could be paying, I mean, I don't know what the different tax rates are for different people in retirement for however much they've got in there, but it could significantly increase that.
So the Roth side of it will not. The Roth side does not. But yes, you are correct. When they start pulling money out of the 401k side or their traditional IRA side, it's going to, depend upon what they pull out, it can potentially raise them into higher brackets, which can affect the taxes that they pay on Social Security, which a lot of people don't realize they may be in a low or no tax bracket on their Social Security if they pull a little bit out of their 401k. But if they have to pull a lot out because they need it, or they need to pull more out because of the tax consequences, that raises their taxable income, which brings more Social Security into taxation, which creates more taxable income. So it's kind of like a snowball effect. That is the biggest benefit of the Roth side of this conversation, is it's not taxable. It doesn't affect the taxation of the 401k withdrawals. It does not affect your Social Security taxation. It doesn't affect any other source of income. That 20,000 you put in over the years in that Roth, in that example you used, growing to 200, that $180,000 for the gain, you could pull that all out. And as long as you have that account for 5 years, that's the minimum rule with the Roth. You got to have that account for 5 years.
Okay.
You could pull that all out, and that $180,000 gain in that example is not taxable.
Not taxable. And it doesn't go against
your income? No, it does not
income?
go against your income. It does not count in any way. It is just money that you can take and spend and do what you like. Or you can use it to grow and generate more long-term income, which means you need to take less from other sources, which keeps your tax brackets down in retirement.
When you have people come in, especially for maybe an initial consultation, if they're not currently working with another advisor, when you're explaining a lot of these types of scenarios to them, is it kind of like a shock to their system, so to speak, when they see that the taxable part of everything when they get into retirement is way more complicated than we probably think of as we're just kind of putting the money aside and we think, oh, we're doing the right thing. I'm putting the money aside, and things like 401ks and, these pre-tax accounts.
Most people don't know how this stuff all works together from the tax side. It's very complicated. Most people don't understand that their Social Security might be taxed. They don't think they should. And I don't necessarily disagree with them on this take. They don't think their Social Security should be taxable, but it all depends upon your overall income. Yeah. So the higher income is, the more that taxation is. Then you start throwing in this 401k has never been taxed. A lot of people have stayed away from Roths, number one, because their 401k, they don't think it offers it, or they can't get a match on it, or they think they make too much money, so they don't qualify for it. There's all kinds of, and some of that information is true, but it just depends upon how it fits your situation and just understanding what you actually have. And a lot of people get in those ruts. They just start putting that money away and they don't think about it. And they're just trying to grow this big lump sum of money because they've gotten this, their head, I've got to have X amount or so many figures in that account to retire. And the reality is it's not about the figures in the account. It's what you get to keep out of those figures in that account. And you need to get out of that rut sometimes and take a look at what do you have available to you under today's rules, under your current plan, because your company's changing those plans constantly. New carriers coming in, new options are coming in. Right. So you may have something inside that 401k plan that you had no idea you had before.
Right. Well, listen, this sounds like it's a great way to educate people on these specific things when it comes to your retirement. Because, listen, I think most people, I'm 50 years old and, I'm just getting into that time in life where I start looking at, I'm going to have to retire one day. And I should probably make sure that that things are kind of in line. My guess is that if you're listening to this podcast right now, if you're my age, maybe you're a few years older, now's probably the best time to start talking to someone like you, Richard, to kind of make sure that your ducks are in a row, as opposed to waiting till the last minute where you're thinking, I'm retiring next year. I should probably talk to a financial professional about the different options I have for when I do retire. That might be a little late to
There's
the game.
There's some people that, we meet them in that stage and it's better than never. But I have a lot of conversations in some of those scenarios where, hey, if we would have met 5 years ago, we could have done this, 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 and this. Specifically when you're looking at the tax side of things. The sooner you start planning for taxes down the road, the better. Because the more money you get into this pre-tax account that's never been taxed, yes, that's a good thing, but it creates some consequences down the road with taxes that a lot of people don't understand until they start projecting that out into the future and what that's actually going to cost them. And now they don't quite have as much money as they think. So I would agree. Yeah. The sooner you start planning from the tax side, the better.
All right. So I'm going to throw you a curveball. I mean, this is the Retirement Bullpen podcast, right? Here's the quick curveball. Simple answer. If what these economists are talking about and that 401ks and IRAs could be abolished, and let's say that there's kind of like a 10-year mark on that, what's your advice to people as far as what they are putting into these 401k accounts right now and moving forward for that 10-year period of time?
So if you had a 10-year window that all the IRA stuff, all the 401k stuff is going away, including the Roth, I would say focus on that Roth because of the tax benefits of that Roth IRA. That would be my opinion. Now, everybody's situation is going to be a little different. So there could be some free matching in those 401ks that you want to take advantage of. But just looking at the surface, I mean, that's where my focus is personally. I'm putting money in, tax-free money down the road, because who knows what tax rates are going to be I'm just a year behind you. I'm 49. I just had my 49th birthday a few weeks ago. And when we're 70, who knows what tax rates are going to be? I just can't even, I don't even want to imagine what it's going to be like.
Unfortunately for some, I mean, you could potentially see the 80s come back and the tax brackets back then were just astronomical. So something to definitely think about. Listen, Richard, thanks so much for the time again today. Just awesome stuff.
Yeah, it's great, Jeff.
Especially as you're talking about, your retirement plan. And if you're currently working and you've got an employer that offers, that 401k plan, ask about that Roth 401k possibility. Do they have that? And make sure that you know what's going on. If you'd like more information, go to WarnerFinancialSolutions.com. Again, WarnerFinancialSolutions.com. While you're there, you can get a lot of different ideas as far as your retirement moving forward. Maybe you want to schedule a time to speak with Richard and the team there at Warner Financial Solutions, just to kind of make sure that, and listen, this may not be the only question that you have when it comes to 401ks, because like Social Security, this is a topic that feels like it's constantly changing, and you need to be making sure that you're paying attention to that. This is the Retirement Bullpen. I'm Jeff Miles. Richard Warner, thanks again as always.
It's been a pleasure.
And we'll talk to you next time.
You bet. Take care.
Insurance products are offered through the insurance business Warner Financial. Warner Financial is also an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Warner Financial are not subject to investment advisor requirements. NPN number 7617022. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be considered as advice designed to meet the particular needs of an individual situation. Warner Financial is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Warner Financial.
Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.